So given our unfortunate view on the market, which is not as optimistic as what probably some viewers out there would like to hear, within Lucerne, let's talk about how we're actually positioning portfolios at the moment, the types of things we actually are investing in, because investors are going to be saying, well, Lucerne, if the market outlook's not rosy, well, how are you actually going to continue to make money over the next 3 to 5 years if it's not going to be by buying your traditional household asset class portfolios such as equity, bonds and property? So how are we going to do it, Michael?
Yeah. Well, I think the important thing is we're always paying attention to what the market's doing. Our view of the market may not be rosy in the eyes of people of traditional long-only portfolio investors, equities, bonds, but it's realistic. And I think that's the important piece, is you've got to be realistic about what you expect asset classes to do, what you want your investments to do, and the types of returns that you're prepared to accept for the risk that you're willing to take. And with all that in mind, LAIF, Lucerne Alternative Investments Fund, plus Lucerne, and the portfolios for our private wealth clients, we're always informed by those particular characteristics, being risk and return. And we use the phrase risk-adjusted return a lot when discussing these investments. And the key for us is being able to position portfolios so that they're somewhat agnostic to what market behaviours do. Obviously, that we're in the market, but they're not driven by people's reactions or a market's reactions. Some of the things that we continue to look at are impact investing. It's one of the toughest areas to find quality investments in. Something that we have probably been looking at for 12 to 18 months and probably only found one that we've been willing to put some money towards. Yep. And that wasn't a true impact investing, but it had enough characteristics to satisfy us. And we've now, we think, come across another one that we're going to make some allocations to that will actually fulfil a lot of the impact characteristics that we're wanting to that we want to see. And by that I mean an impact or an ESG fund isn't one that calls itself that because it invests in things that sign up to the UN Convention. You've actually got to see something meaningful take place. And
we've looked at a number of these ESG funds around the world, some of the larger ones, and Microsoft appears in the top 3 investments in their portfolios. And I mean, give me a break from an impact investing perspective. Microsoft fits that bill. And I think historically also one of the questions that investors were always asking us about 5 years ago was about this ESG and impact investing theme. And I think it's fair to say now the market's probably caught up to that, and absolutely, and echoing Nick Griffin from Munro's comments recently, this new wave of the world waking up to environmental change, the climate footprint that companies are going to be beholden to is now a real thing, and we've got to spend the time and the work now figuring out and deciphering who is real in this space and who is actually delivering on these mandates versus the majority of managers in this space that are not. And just because you don't invest in tobacco, porn or firearms doesn't make you an ESG fund, whereas historically that was sort of the filtration process that some people would go through.
And also a lot of the big investment companies. I had a conversation with one of the largest super funds in Australia's investment analysts about this particular topic, and just posed, well, how does Woolworths fit into your no more bad investments, if you like, using an ESG screen? And they've always got reasons why, well, that can stay. That one can stay, that one can stay. And that's because without those companies in their portfolio, they're missing out on a large chunk of what the ASX top 10, top 20 stocks do, which is where the performance comes from.
And they've got to be beholden to the market. That's what their mandates require.
Yeah. So to that end, we've, as I said, come across a fund that we think on a global basis has really put to the test some of those characteristics that we've found challenging. And they've come up with some screens that we think test for a lot of what we want to see adopt. And impact investing still gets informed by the E, the S and the G in ESG, but it actually makes a difference. And what we liked about them is the fact that they are looking for more than 80% of the revenues from any of their investments actually making a meaningful contribution to something to do with the environment. And finally, that's the breath of fresh air that we've been looking for, and we're going to start allocating to that from next week, and we'll probably start showing it to client portfolios as well.
Exactly, and we'll talk about the specifics of that fund and name them shortly, but talk about some other themes in the portfolio that are working well for us, and this is something that you've really led at Lucerne, and that's starting to allocate capital to the private debt space. I mean, from a portfolio perspective, using what's happened over the last 12 years where the S&P 500 has annualised 16.5% per annum since the GFC, and to put that in perspective, over 100 years it's done 8%. So it's doubled the average annualised return every year for the last 12 years. Again, is that sustainable? But if we use that long-term return of 8% per annum, I think many investors out there, for the risk they're actually willing to take, not what they think they're prepared to take, but actually willing to take, that sort of net annualised return of 8% sensible. What we've been able to identify in the private debt and mortgage space is a portfolio for investors that allows us to deliver a return of sort of net 7.5 with monthly income, so an equity-like return with full security over an asset, and so we've obviously started deploying a lot of capital to the private debt market and been very selective in how we do that, and obviously launched something ourselves recently. But just talk about maybe that private debt space for our viewers as a whole, and the types of returns and those risk-adjusted returns we can deliver.
Yeah, well, private debt's been around forever, and it's something that all of a sudden has got a lot of traction because a lot of players are participating. And I think the key elements to
and
it...
cash and bonds are on the floor.
Exactly.
So what is that, again, Tina, we've got to bring it back into the conversation,
Yeah.
but what is that alternative, and private debt's now come to the fore for us? Yeah.
No, exactly. And that's one of the things that you look for when you're wanting to make an allocation of a client's capital, is what sort of return can they generate. Again, I'm repeating myself because it's so important for the risk that you have to take. And private debt, and by private debt I'm talking about first mortgages, essentially investing in property, lending money to borrowers and getting the returns paid to investors. And we've identified monthly as a key factor because a lot of investors are struggling now to find income and to generate income to sustain their lifestyles. And you don't want to be always selling assets to fund lifestyle. So
you want to sell assets when you want to sell assets,
exactly.
not when you're forced to. And I think just for investors out there to understand this, you can find a physical asset like a quality tier 1 asset that we're about to fund in Church Street down the road here in Richmond. That's right next to the Melbourne CBD. We're able to take a first charge over that asset at a 65% LTV or LVR, and to put that in perspective, banks historically will lend against the house in this country at 80%. The purchase of that property shows up with 20% equity. The bank's there for 80%. We're showing up with 65% and expecting 35% to be there from an equity perspective. Over a 12-month period, we're generating that net return into our investors' accounts of 7 and 7.5%. And it's a really interesting space where we can be quite opportunistic in, because our top 4 banks and the other banks in Australia at the moment, they're much preferred to lend to the residential property market because it's just far more profitable to them and more efficient, and it's easier, and they can grow their loan book that way. So they're actually providing a space for us and our investors to move into and support well with a partnership that's 50 years old in Victoria. And that's something that we think deserves a meaningful allocation in portfolios at the moment, particularly the current market environment we're in.
Yeah, definitely, and that's the key. And you've identified, the major banks have retreated from that market considerably over the last 18 months. Part of it is because it's much cheaper for them to fund housing, the way that the capital adequacy structures are in place for large financial institutions. But in addition to that, the investor capital. So if you're an investor and you're putting your money in the bank, you're getting 0.5% on a good day for a 12-month term deposit.
Yep.
And the bank's taking that 0.5% term deposit and funding home loans at 80 to 85% and getting back their 1.5–2%.
Yep.
We're saying that investors have the opportunity to fund a return that gets them 7.5% for a similar risk that you're taking with a bank.
Yep.
Obviously, it doesn't have the bank guarantee, but likewise, you're making a quality decision on risk. And for the return that you're prepared to take.
But you're also getting often a personal and company guarantee behind that as well, in addition to the mortgage title.
You get all of that, and transparency, and with the portfolios, you can see the security that's held in the portfolio. You get your car, you can drive
past it. You can
walk
down the street and see the asset right here. It's a 400-metre walk away. So it's a quality point. And I think another theme that we've been spending a lot of time for an investment committee level in the last 3 to 4 months, and we're getting prepared to again allocate to, is volatility. We've spent a lot of time working at the moment and scouring the globe for a volatility allocation in client portfolios, and of course with inside Leif. And so where our mindset at the moment is that if we do see that car crash event eventuate again, or if we do start to see a market correction, for our viewers to understand this, that volatility tends to spike the most when markets come off. That old saying, bulls go up staircases, bears come down elevators. So when markets sell off, they tend to sell off in an extreme period. It took 4 years to get to the high of the globe. It took 4 years to get to the end of the GFC, and then we saw 18 months and all those returns were eroded within an 18-month period. So at the moment, why we're looking at a volatility allocation, particularly within LAIF, is that you can take that sort of 2 to 3% position, and if volatility spikes from where it is at the moment from 20 to 40 or 50, again from an index perspective, you're making a multiple return within the portfolio, but you're providing that underlying sort of hedge and protection. And then when things calm down and the circus leaves town again, you can actually remove that volatility position from the portfolio. So when we think about portfolio construction, yes, we've always got some long-term themes sitting there within LAIF. A number of our managers that are in LAIF today have been there from day one and have performed well at different parts of the cycle. But then you need to overlay that with medium and short-term themes in the market as well. And one of those short to medium-term themes we're looking at the moment's volatility, and we think the best way to go about that's actually to potentially just go and purchase the VIX or the volatility index in the US, and that's obviously something we're looking to bring into portfolios over the next 2 weeks as well, in alignment with our impact fund.
Yep, that's our insurance policy, if you like.
Exactly right. No, exactly right.
Yep. So one of the things that we talk about often with our investors is the attraction that we have to startup funds or managers. So maybe expand a bit more on why we're interested in startup funds and managers, and a couple that we've been allocating to recently.
Yeah, sure. Well, emerging managers as a whole is a bias that we've had in LAIF over time. Look, in investing, being early pays. And it pays well. And if you look at some key stocks that everybody knows in the market, CSL struggled to get that float away in the mid-90s, and those that were fortunate enough to participate then have obviously made multiples and multiples on their money. Afterpay is a great example that everybody knows about at the moment. Some of our funds that we own in LAIF saw that story very early on, believed in it before the rest of the market even knew about what buy now, pay later what actually was, that whole thematic, and even what the concept was. So those that purchased Afterpay at $3 to $5 did very differently than those that purchased Afterpay at $80, $90, $100 when the rest of the world knew about it. You can actually apply the same approach to fund managers. When we look at startup managers, I'd like to focus on the fact that we're actually looking at managers that have generally cut their teeth at a much larger institution, so they understand the craft of investing and funds management. But then they're looking to set up their own business by themselves, just like with professions around the world. If you're a good lawyer within a law firm, you might go and set up your own practice. If you're a good accountant, you might go and set up your own accountant. Same for a doctor, you might specialise in a particular field, so you go and set up your own practice, say being a heart surgeon. We apply the same approach when you're looking at funds management. There is so much material out there and research that shows that many emerging managers or startup managers actually deliver their best performance in the first few years. Why is that the case? Because they're running a finite pool of capital. So if you think about funds management as a whole, it's an interesting space, because in the industry as a whole, the larger you get, the more inflexible you become, and that just comes down to liquidity. If you look at behemoths in this world, like say your Platinums and your Magellans of this world, and I take my hat off to them, they're great institutions and they've performed well over time, but the larger they get, the smaller the universe is of companies they can actually invest in for liquidity reasons. If you're running $100 billion and you want to take a 1% position in your portfolio, you're buying $1 billion of a company. Even trading $1 billion of CSL or CBA is not easy when the market cap of those companies is circa 120 billion. If you're a fund manager that's starting off with 10 to 20 million, I mean, you're like a jet ski compared to the QE2 with a turning circle. So you have the ability to move in and out of markets very easily. You also have the ability to be very flexible with your capital. So you can take large cash positions, you can move in and out of different market sectors, and you're never really getting stuck in companies if liquidity does dry up, so you can move. So that's important to us. Also, when a fund manager is starting off, they're not on everybody's radar. And as a result of that, given the extensive network we've now built up, particularly via LAIF, we're now seeing these managers actually coming to us with concepts and ideas that we might want to support. And we saw that last year in resources, when we felt that the resources thematic was going to play out at the start of the year. And so we looked to Perennial, who we're already a partner with and had client capital invested with, and we backed Sam Berridge and his team to set up the Global Resources Trust. We were the only investor in that trust on the 1st of April when he launched. We were the only investor for the first 3 to 4 months, of course, alongside Sam's personal capital. And within those first 3 months, that fund delivered a return of 40%. Then everybody saw the 40% return and said, right, I'm now going to get on board with it now, and that's where your herd mentality comes from. But probably two of the biggest themes that we're looking for in LAIF at the moment, One's not from a startup manager, and that's the TT Global Environmental Impact Fund that I'll let you talk to in a second. But the other one is a Pure Asset Management. Pure Asset Management launched a fund about 3 years ago now called their Income and Growth Fund. But they recently saw an opportunity in the market in the resources space where they could actually come to resources companies with their mandate. And their mandate is to provide debt to businesses with an attaching equity optionality. And what I mean by that, it's either a warrant or a call option to eventually own that equity in that company if it delivers. And this is a really important, powerful point, particularly for the resources space as a whole, that it's a thematic that's playing out, but it's a thematic that carries a lot of volatility. And we're trying to reduce investor volatility in returns as a whole, that whole underlying theme of risk-adjusted returns. You think resources, you think highly volatile, and you think also questionable outcomes in the space. So how do we still want to own that theme, yet reduce the volatility? And we can do that via Pure Asset Management, where they're going to these businesses, they're providing them debt of say $5 to $20 million, and they're profitable resource companies already, and they're doing that with a coupon attached to that of 8 to 12%. So you're already realising that 8 to 12% annualised return in debt. Now, if these businesses do perform and deliver, and those equity prices go up by multiples, they're then converting that debt into equity at a significant premium to that warrant or call option strike price. And that's when that portfolio can generate significant returns. So their mandated returns annualised 15% per annum for investors over time, and they've delivered 25% per annum because they're not only picking the right companies, and to date, the fund has never lost on an investment. Whereas if it owned the equity in these investments, it would have lost on the investment over time, on some of those investments over time. So it's a really disciplined approach. And so we like how they've adopted that approach now to the resources space. And so we've added that fund when it recently was established on the 1st of May this year, as has come into life. And maybe you'd like to talk to us about the TT Global Impact Fund.
Yep. And I'll be brief on this because I did speak about it a bit earlier without naming it, but it is a global impact fund. Impact investing, as we've already said, is a theme that we've been studying and looking into for quite a while now, but trying to find the right fund has been the difficulty for us. We think we've done that with this fund, and yes, they're a new fund, but they're part of a long-established global fund manager, but they've also just identified that the opportunity exists to have this as a standalone investment, and they're not, look, in the scheme of what size they are and the amount of money they invest, the fund isn't particularly big now. We'll be, again, relatively early
but that's
into
that theme
this.
that we want,
exactly.
Right? Yeah.
Early into the fund. It won't be first, but we'll be early. And but what, as I said earlier, we really like about it is that there is a lot of discipline about how they're going to deploy that capital. They're aligned as well. They've got each of the managers has all their investable capital in the fund. Another thing that we look for when it comes to investing with people, it's also alongside them then. And in addition, this way that they want to see that any company, the over 80%, that's a fairly large target of their revenue, is actually making a meaningful contribution or difference to the environment, hence the impact terminology.
And also, it's the first we've seen for a manager where 20 to 30% of their actual management fee for the fund is actually going to charitable organisations that actually benefit the environment. So, from an impact perspective as well, they're true to their words and their actions in terms of actually what they're doing, even with their remuneration, putting back into the community, which I think's excellent. Where we're trying to be different in this global impact space, and I'm happy to go out there and say this is where maybe Lucerne's been a little bit different and contrarian, is I think when most investors think about the drive to be carbon neutral in 2050, the whole focus is on actually developed nations around the world and your more westernised markets. Or if you actually think about where probably the most ESG issues actually lie, it's in emerging markets. Out of the top 50 cities in this world that have the most pollution, the majority of them sit in China and India. TT Global have been operating in emerging markets for the last 30 years as investors in equity space. They've already got deep roots and networks within China, within India, within Southeast Asia. And so a large portion of their portfolio is actually biased towards impact investing in emerging markets, where you're ultimately going to get a much greater outcome for the planet than obviously funding businesses that are in more established markets that are probably more ahead of the game already in the ESG space, which is ultimately then should lead to greater investment performance for investors, because you're identifying themes that are probably more underpriced in the impact space versus ones that are already more established.
Yeah. imperfectly priced, and we've spoken a lot about emerging markets and the opportunity that exists there as well. And this is just another one of those that combines both that emerging markets opportunity
of both worlds.
and the impact investing.
You get the impact theme and you get in the emerging market economies. And for our investors out there, that just to understand this, over the last 10 years, emerging markets have significantly underperformed developed markets, and that's a theme that often doesn't last in markets. So if you're a betting person at the moment, you'd probably argue there's a much greater chance of upside in emerging markets on a go-forward basis than there is developed economies.
Yeah, I agree.
Thank you, Michael. Appreciate your time today.
Thank you.
I'd just like to thank our Livewire audience for tuning in to today's session. I trust you found it insightful, and good luck on your investment journey ahead.